Ever feel like trying to make sense of income tax is like untangling a huge knot? You're definitely not alone.
Hmm.
And with the proposed changes in the Finance Bill 2025, well, things are certainly getting a shakeup.
That's right. We're going to dig into a really key piece of legislation today, the Finance Bill 2025. Specifically, we're zeroing in on Part 2.
Right, the income tax part.
Exactly. It's all about income tax and the proposed amendments within it. And our main source here is the official Kenya Gazette supplement, the one dated May 6th, 2025.
Okay. And while that whole bill is massive, our focus today, our mission is clear, right? We're just unpacking the income tax proposal.
All right.
We want to make these potential changes, understandable for you, the listener, and highlight what you really need to know. We'll try to avoid getting lost in all the jargon.
Think of this as your guide, your shortcut to understanding the main income tax changes that might be coming. We'll break down what's being proposed section by section in the Income Tax Act and talk about what these shifts could actually mean in practice.
Okay, let's get into it then. Part 2 of the Finance Bill 2025. It's all about tweaking the current Income Tax Act. And the first thing they seem to be looking at is definitions, the very foundation.
Precisely. Section 2, which is basically the dictionary for the Income Tax Act, is up for several revisions. Some definitions are being amended, others deleted entirely.
Okay, like debenture. Now, for most of us, that's basically an IOU, right? A formal debt document.
Essentially, yes.
And the proposal is to remove a specific phrase from its definition they want to take out. And, for the purposes of paragraphs D and E of Section 7.1 of this Act, includes any loan or loan stock, whether secured or unsecured. Why does removing that bit matter?
Well, what's interesting is how this might refine what counts as a debenture, specifically when you're looking at deducting interest under those particular subsections 7.1 D and E.
Ah, okay.
It could, clarify which types of financial agreements are treated strictly as debentures for those specific tax deduction purposes. It might affect how companies structure their borrowing.
Right, subtle but
Right.
potentially significant. Okay, what else? Individual retirement fund. The definition is losing the phrase subject to the income tax retirement benefit rules.
Yes.
What might that imply? Fewer rules or different rules?
It's like you have the main act and then these separate detailed rules. Removing that phrase might suggest integrating some of those specifics more directly into the main act itself.
So potentially simplifying where you find the rules.
Could be. Or maybe adjusting how those benefits are treated for income tax overall. It points towards a potential shift in the regulatory approach.
Now, this one sounds very current. The definition of royalty is getting an addition
Mm-hmm.
they want to add, and includes the distribution of software where regular payments are made for the use of the software through the distributor right after support fees. This feels very targeted at, software subscriptions.
Exactly. Software as a service, subscription models. That's how so much business is done now. This proposed change explicitly brings income from that model, regular payments for software use, via a distributor under the royalty definition for tax.
So, clearer tax implications for software companies, distributors, anyone in that chain.
Definitely. It clarifies their tax position in Kenya.
Okay, but some definitions are just gone. Compensating tax, tribunal, and venture company are proposed for deletion. What did those even cover?
Well, compensating tax, often related to tax paid when a company distributes profits after receiving certain tax benefits. The tribunal likely refers to a specific tax dispute resolution body,
Right.
and venture company was tied to tax incentives for, investing in new or risky businesses.
So removing them might mean those specific mechanisms are changing or maybe being handled differently elsewhere in the law.
That's the likely implication, yes. Either the concepts are being phased out or absorbed into other frameworks.
Okay, probably the biggest definition change, though, seems to be related person. The old one is out, new one is in, and it sounds broader.
It does seem significantly broader. The new definition really expands the net. It's not just about direct control or ownership anymore.
How so?
It now includes anyone who participates, directly or indirectly, in the management, control, or capital of both businesses being considered.
Okay.
And importantly, it also ropes in individuals involved in managing or controlling both businesses if they're also linked by family ties, marriage, blood, affinity, especially if the businesses are also involved in the individual's own business dealings.
Wow. Okay, that's
Yeah.
a lot of potential connections. And it mentions deleting the old subsection 2, which probably gave more context. Why is getting this related person definition right so crucial for tax?
It's absolutely fundamental, especially for transfer pricing.
Making sure related companies charge each other fair prices.
Exactly. preventing profit shifting to low-tax places by manipulating prices between related entities. This wider definition aims to tighten those anti-avoidance rules, making it harder to structure around them.
Makes sense. Okay, moving away from definitions. Section 5 deals with monetary thresholds, and one of these numbers is jumping up.
That's right. The proviso to subsection 2, the current threshold is 2,000 shillings. The proposal is to change that to 10,000 shillings.
That's a five-fold increase.
It is.
Now, we don't know the exact rule tied to that subsection offhand, but raising a threshold like that usually means fewer things trigger the rule, or it applies differently.
Generally, yes. It changes the point at which that specific provision kicks in. Adjusting these thresholds can really alter the practical application of certain tax rules, impacting who qualifies for something or when an obligation arises.
Okay, let's talk about personal reliefs then under Section 8. This is something that affects individuals directly. What's happening there?
Couple of things. First, a language update. The word husband in subsection 1 is proposed to be replaced with spouse.
Good. More inclusive.
Yes, it reflects modern family structures better. But the bigger change seems to be the deletion of several whole subsections.
Which ones?
Subsections 4, 5, 6, 7, 9, and 9A. They're all proposed for deletion.
That sounds like quite a few potential reliefs being removed.
It certainly suggests a significant reduction or streamlining of the available personal reliefs that taxpayers could previously claim to lower their taxable income. Without the specifics of each subsection here, the overall direction seems to be towards fewer individual tax breaks under this section.
Right. Okay. Section 10, this lists what counts as taxable income, and it looks like 2 new items are being added.
Correct. They propose adding 2 new paragraphs right after the existing ones.
Yeah.
Supply of goods to a public entity and sale of scrap.
So money earned from selling goods to government bodies or from selling scrap metal, for example,
Yes.
is now going to be explicitly listed as taxable income, removing any doubt.
Precisely. It brings those specific income streams clearly under the income tax net, formalizing the tax obligation for those types of transactions.
Okay. Back to the digital world for a moment. Section 12E, taxing the digital economy. There's a clarification proposed.
Yes, in subsection 1A, they want to insert the phrase, the internet or an electronic network, including through, right after carried out over.
Making it broader.
Essentially ensuring it covers digital services delivered via any online or electronic means, future-proofing it a bit as technology changes. It just makes the scope very clear.
And something else is being deleted there, too.
Yes. Paragraph D in subsection 3 of that same section is proposed for deletion, which would modify the specific rules within that part of the digital tax framework.
Got it. Now, Section 12G minimum tax, this was relatively new itself, wasn't it?
It was, and now there's a proposed new subsection, 3A.
What does it say?
It states, minimum top-up tax shall be payable by the end of the 4th month after the end of the year of income.
Minimum top-up tax, so an additional layer to the minimum tax.
It appears so. It introduces this concept of a top-up amount related to the minimum tax and sets a clear deadline 4 months after the year end for paying it.
So potentially another calculation for businesses subject to minimum tax, maybe ensuring a certain baseline tax payment.
That could be the aim, yes. Fine-tuning how that minimum tax system works in practice.
Okay, let's move to Section 15 deductions, always a key area for businesses and individuals trying to reduce their tax bill. What's the big change in subsection 2?
A significant one relates to paragraph G. The existing paragraph G is proposed for deletion and replacement.
And the new one deals with?
It deals with the deduction for the decrease in value, the wear and tear, essentially of smaller items used to earn income. Things like implements, utensils, tools, items that aren't big machinery or plant covered elsewhere.
Okay, so how we account for the cost of those smaller tools.
Exactly. And the crucial change in the new proposed paragraph G is the deduction rate. It's proposed at 100% in that year of income.
Wow, 100% deduction in the same year you buy them.
That's the proposal.
That sounds like a big deal for businesses using lots of smaller tools or equipment. They could write off the full cost immediately against their income for that year.
Absolutely. It's a significant change, basically allowing an immediate full deduction instead of spreading it over time. It simplifies things for those specific assets.
Are other deductions changing there too?
Yes, the proposal also includes deleting paragraphs, I and J, in that same subsection too. So whatever deductions those paragraphs covered would be removed.
Okay, so some deductions potentially becoming more generous, others being removed entirely. It's a mixed bag.
It often is with these kinds of amendments. Now, beyond these specific sections we've unpacked a bit, Part 2 proposes a really wide range of other changes across the Income Tax Act. We can't go into every single detail, but it's worth noting the sheer breadth.
Right, just to give people a sense of the scope.
Exactly. For instance, Section 21 sees a deletion concerning gross investment receipts. Section 27 gets a new bit about what happens if the commissioner misses deadlines on applications.
Section 35, something about shipping income.
Yes, a new paragraph on income from ship owners or charterers, plus deletions of several existing subsections there. And Section 37 looks like it's getting a major overhaul regarding employee allowances and benefits.
Ah, this is often complex. What kind of changes?
It looks like they're getting much more specific about what's deductible and how benefits are valued. For example, setting specific limits, like maybe 2,000 shillings daily for subsistence allowances, or using standard mileage rates for car travel.
So less room for interpretation, perhaps.
That seems to be the goal. The proposal details how to treat company cars based on engine size and age, employer-provided housing, contributions to pension funds, group life policies, club fees, even loans to employees or directors.
And shares given to employees.
Yes, the tax treatment of those two.
Yeah.
And importantly, it proposes a clear definition of employee for these rules. It's aiming for much more precision in taxing total compensation.
Right, standardizing how you tax the perks beyond the basic salary.
Exactly. Then there are other amendments. Section 39 related to individual income. Section 52B on company self-assessment liability. Plus, the outright repeal of a few sections, 54B, 72B, and 72C.
Repealing whole sections. And it doesn't stop there, does it? Even things like information sharing and penalties.
Correct. Amendments to Section 104 on information provided under Section 101, Section 109 on failure to file returns. Section 131 is also proposed for repeal. And even the schedules, the lists at the back of the Act are being changed.
Schedules, too. Like what?
The first schedule, Part 1, which lists tax-exempt income, sees changes. New exemptions proposed for gains on property transfers in special economic zones and for securities traded on the exchange.
Okay.
The second schedule, paragraph 1, dealing with fringe benefits and qualifying interest, is amended. It introduces specific tax rates for companies certified by the Nairobi International Financial Center, tied to investment levels, holding company status, or being a certified startup.
Interesting. Specific rates for NFC companies?
Yes. And changes to other paragraphs in that schedule, including a new one setting the tax rate for fringe benefits. Even the definition of company in the 8th schedule is up for amendment.
It really is a comprehensive review, touching almost every corner of the Income Tax Act.
It is. And as you mentioned earlier, other sections dealing with pensions, management fees, interest, rent income, they're also targeted. Plus a whole raft of changes, clarifying deductions, what's allowed, what's not.
Like what kind of deductions?
Proposals touch on bad debts, capital spending, soil erosion prevention costs, legal fees, business startup costs, premises maintenance, entertainment, hospitality, vacation trips, employee dependence education, insurance, retirement scheme contributions, both registered and unregistered, advertising, research, building social infrastructure, sports sponsorships, donations, post-retirement medical fund contributions, ASHIF contributions, interest deductions. It's extensive.
Right. So wrapping this up, our deep dive into just Part 2 of the Finance Bill 2025 shows proposed changes everywhere in income tax, from the basic definitions to how digital services are taxed, minimum tax, personal reliefs, very specific deduction rules, employee benefits. It's a lot.
It absolutely is. The breadth and depth here really signal a potentially significant evolution in Kenya's income tax system.
And while we've tried to, map out the main areas for you, our listener, it's so important to remember this is a high-level overview of proposals.
Crucially, yes, these are proposed changes.
We really encourage you to look at the full Finance Bill 2025 yourself, get the complete picture, see how these specific proposals might actually impact your own situation, your business.
Definitely seek out the full text or professional advice if needed, because this evolving tax landscape in Kenya means staying informed is, well, more critical than ever.
Absolutely. And maybe it leaves you wondering, with all these adjustments, what's the ultimate goal for the tax system here? And how will these changes shape the economic playing field in the coming years? Something to think about.